name is Vita. I'm the CEO of Columbia Care. We have operations in 6 jurisdictions throughout the United States, and we're fully integrated in each one of those, so we manufacture and provide dispensary services as well.
My name is Herrera, and I come from a banking background. I've been in financial services in excess of 24 years. 18 of those years I worked for a commercial bank. I was Chief Information Officer of the institution. I also manage all of our bank card products. I have extensive experience in the issuing of credit cards, the acceptance of credit cards, ACH, electronic payments, wires, everything along those lines. I've been with a company called Hypur for a little over 2 years now, and we provide technologies to financial institutions that enable them to bank spaces like the cannabis space.
My name is Krane. I'm the president of Forefront Ventures. We're Forefront Ventures, a holding company. We've got a few ventures that we have that operate in the space, including Forefront Advisors, which is our best-known business. We're a consulting firm. We help folks navigate the regulatory environment, get licensed, and help them set up their operations. We've also started doing some direct investments in the space, as well as we've launched a new brand to go for some licenses on our own. We also, my background is primarily in the policy realm. Before getting into the industry about 7 years ago, I was executive director of Students for Sensible Drug Policy for about 4 years, and for 6 years prior to that, worked with the National Organization for the Reform of Marijuana Laws.
Well, great. Wonderful group of panelists we have here. Maybe it is appropriate, or maybe it's not, to pick the CPA to moderate this panel, because I have nothing but questions that I get from my clients. So I'm glad to have experts here on the panel. And I'm just going to fire out the questions for whoever feels the most comfortable to handle it. And if you have questions from the audience, don't wait for the end. Just go ahead and raise your hand. We'll try to work you in if it's related to the topic that's currently being discussed. The first question I always get from clients or potential clients is, so what's going on with this banking thing? Why is there a problem with bank accounts, and how do the mechanics of this work? Is my banker going to go to jail if he gives me an account, or is it some other, like, is he saying maybe he just doesn't want the business, or, do we really know what are the mechanics driving the lack of banking services for the industry?
I can share some thoughts from our experience. We have been very lucky to be able to establish banking relationships in all of our jurisdictions, but I think that what I see here in front of me is really indicative of sort of the misperception. If anyone is interested in this industry, this industry cannot survive without banking relationships. It just can't. It's unsustainable. And I think that the stigma of the product and the stigma of the culture has somehow infiltrated the practical realities of the compliance liabilities, because ultimately where we always end up when a relationship is initiated and doesn't move forward, where we have the problems, it's at the compliance point, and it's not driven by federal policy. We've gone through an OCC regulated review through our banks, one of our banks. We have relationships with federal credit unions, with FDIC institutions, and they're very transparent and productive. But ultimately, the industry hasn't recognized the value and importance of accommodating the requirements of a banking system. So, for example, when we go to a bank, the first thing we do is we literally do a complete review and redo of all of our policies and procedures to accommodate whatever issues the compliance departments are concerned with. So whether it's KYC, AML, or whether it's cash handling procedures, it doesn't really matter. They are there, but we are lucky to have that conversation with them. And I think that's the difference, is that my background, I've worked at Goldman Sachs for many years, so I know what banks are under in terms of regulatory scrutiny. And there is no upside for them to open up a one-off account. So if you think about it just in economic terms, why would they take the risk on? So what you have to do, what the industry has to do, is come up with best standards and practices that everyone abides by. The first way to do that is, I think, through the regulatory process, and the second way to do that is to find a body that can actually self-regulate in some respects and provide that leadership.
Yeah, actually, let me expand on that a little bit, and let me come at it from the banker's hat. So I'm going to put my banker's hat on, and let me tell you what's going on there. Is the banking of cannabis a permissible activity? And the answer is yes, absolutely. From the Federal Reserve to the FDIC to the NCUA, everyone says, yes, this is a permissible activity. All right, now what you also have to consider though, is it appropriate? So just because you can do something doesn't mean that you should do something. And that also falls into our regular everyday lives as well. And so what these institutions need to look at is, although I can do it, is it appropriate for my institution to get involved in the banking of cannabis? Right? Some factors there is, what is the CAMEL rating of that institution? A CAMEL rating is a composite rating for that bank or credit union. It's not a public number, but it's a number that's typically between 1 and 5, 1 being the best. If you're a CAMEL 3 or a CAMEL 4 bank, you probably shouldn't even think about getting into space because you've got some problems already in that institution, so you wouldn't want to complicate things. How is your board of directors? Is your board of directors behind this? If you have 2 members that are against, there are 3 members against, and maybe 4 that are for, you might have some trouble there. When the regulators come into these banks, they go to the minutes of the board. They not only want to see the dialogue between the board members, they're even asking for the tone of the discussion. So how is that discussion within the institution as to banking that space? Right? Outside of that, you've got your management. Is your management team going to be on board with this? One of our institutions had an operations manager, and the operations manager was just morally opposed to the product. Now, the board was okay with the product, and they fired her. Right? So is your team, your management team, going to be on board with this product? Nicholas mentioned BSA-AML. BSA-AML is extremely important. What is the strength of your BSA-AML department? BSA is Bank Secrecy Act. AML, of course, is anti-money laundering. So you must have a strong department in BSA-AML if you're going to think about getting into this space. Resources. How much money does the institution have that they're going to allocate to this? Banking the space is not easy. There's additional work that has to be done. So they shouldn't go into this lightly. So what are the problems? Well, it's a cash-intensive business. At the end of the day, it's like any other cash-intensive business. Those types of businesses have problems getting accounts today. If you're a check casher, if you're a money service business, if you're in the payday lending space, you already have problems, all right? And those are in federally legal areas, all right? So you put something that is federally illegal, and now that starts complicating the matter substantially.
So a lot of the problems are coming from bank regulators, putting pressure on the bankers and making them feel uncomfortable that they haven't got all their ducks in a row. Then why have we seen so many banks jump into the space only to jump right back out?
Okay, all right. Let me address that with 2 answers. All right, so when you start looking at the guidance out there, so let's talk about what are the regulators giving to the banks. All right, so there is the FFIEC, and basically they're an examination council. And the examination council writes best practices, examination handbooks, and these documents are used within financial institutions for the examination process. If you go to the FFIEC's website and you do a search for the Cannabis Banking Handbook, it doesn't exist. It's not there, right? So there's not a lot of guidance from the steps or the processes or what boxes must be checked from an examination standpoint. So what do we have? We actually have 2 documents that help us get into this space. Right? One is a FinCEN document from February of 2014, and then we have the Cole Memorandum. We have a gentleman here, his name is John Vardaman, here in the front row, and John just came on board with our company, and actually he's the gentleman that penned the Cole Memorandum. And so John was formerly with the Department of Justice and has quite a bit of experience from the DOJ's standpoint of the Cole Memo.
The 2013 memo? August 2013?
No, that was Cole 1 that dealt with general enforcement of the CSA. This was February 14 that dealt specifically with the financial.
Okay, I need to who's in lockstep with that number. Okay, it explains that number.
Yeah.
So there's not a lot of guidance out there, and so some of these bankers are going, all right, well, they're trying to figure out what do we have to do to be compliant. What should we do? Because there's not a guide of best practices. In general, when you're talking with the FDIC or the FRB, they'll tell you whatever you're doing now, if you're here at this level, you need to ramp it up. Right, so what I would call today's due diligence is like, the enhanced due diligence. Right? Things are only going to get more difficult from a regulatory standpoint. They're not going to get easier. And Luigi, the bankers aren't worried about going to jail. They're really not. More of what happens in real life in an institution is that the regulators have MOUs, they have consent orders, you have cease and desist out there, and then you have civil money penalties. And so they're more concerned about getting fined and having their regulator, I'm going to use an analogy, just kind of turning the screw on you and just making your life difficult. Right? In theory, a regulator should not tell a bank to get into space, and they should not tell the bank not to get into space.
Can I
have one point,
Sure,
sort of
sure.
point? The other issue we've encountered is I'd say it's almost sort of guilt by association, where a bank has reputational concerns. So they may be able to get over all the hurdles that they're facing from a regulatory perspective and from the internal compliance perspective, but they ultimately look at their client base and how they're sustaining their economic value, and they make a decision on whether or not there's a subtext that they're unaware of. And in many cases, as we've seen, they will go out to their largest clients and they'll ask them, do you have a problem with this industry? And so there's something that's not even written that's really more subtle that can end up delaying or frankly derailing a relationship being established, because many large companies simply do not want to be associated. They don't want to have their funds commingled with a Schedule I product. But it's not necessarily about the schedule. I think a lot of times it's a philosophical issue with their perception of the industry.
So let me turn it over to Kris here. We've heard now a little bit from sort of the banker side of the equation. We know you consult a lot with business owners. So what are business owners doing? I mean, when they're at the sort of, you work with them at a very beginning stage, and what are some of the strategies they're employing?
Well, more and more, thankfully, they are able to actually just access banking, and that was not the case 3-4 years ago, certainly before the FinCEN guidance. But even since the FinCEN guidance, it is still a challenge, and I think the points that have been raised so far are spot on. There's also the additional challenge, I think, when it comes to, particularly to larger institutions, that there's a limited amount of sort of banking activity that they can actually engage in this industry. And nobody's going to be, the banks aren't going to be lending. Certainly under the guidance that they have now, we're not talking about large loans where they might realize large returns. We're talking about opening checking accounts. There's not a whole lot of money just opening checking accounts, especially in an industry where there just aren't that many players. And so it's one of the reasons. So if you're a really large bank, the risk reward, it's not worth it. If you're a smaller state bank or community bank, those are the folks that are typically getting into the business. But we see businesses that now have access to banking that may not have before. But in some cases, in some states there may be only one bank that publicly announces that they will open checking accounts for the space. And so we've seen, in Massachusetts, for example, there's one bank that is public about it. There are a few others that aren't quite so public, but most groups don't know about them. And so if you're fortunate enough to get an account, you're going to pay $6,000 a month for the privilege of having a checking account. So that's certainly one thing.
So they're realizing that there's no money in the lending, so now they're squeezing fees out of the banking.
Correct, and there's some justifications for it.
There's also the increased scrutiny that you're undergoing.
Correct.
There's an enormous amount of money that has to be spent scrutinizing and satisfying the requirements of these.
That's exactly the point I was going to make. They're not just charging, what some might consider outrageous fees just because they can, although some of it is, right? If you're the only bank in the state, then sure, you can charge more for it. But some of it has to do with, they've got to, under the FinCEN guidance, they've got to file a suspicious activity report quarterly. They've got to keep all of their operational policies and procedures on file and have those reviewed regularly, and they have to have their application for the state on file. So there's a lot of administrative burdens on the financial institutions just to maintain a checking account, and so it's justifiable that they would charge more. What we have seen traditionally, but we still see a lot in this industries, for those groups that can't find a bank that's willing to bank them totally above board, the most common thing that you see in the industry, this is not something that we advise, but we certainly see it out there, are groups that basically hide what they're doing, right? So they set up a bank account and they say that they're an herbal remedies company. Or something along those lines. They never actually say that they're a cannabis company, and that will often allow them to keep that bank account for upwards of 2 years, sometimes less. Every 2 years.
And are the banker sort of complicit in this? Don't ask, don't tell?
Sometimes they are, sometimes they're not. It really varies, but more often than not, they're not. The bankers think they're an herbal remedies business or a floral business or whatever company or industry they say they are, and it's not until oftentimes it's not until say 2 years in when their account's going through an internal bank audit that they realize, oh wait, this is a marijuana company, and they get a letter saying, you got 30 days to collect your money, we're going to shut your account down. But we see it get shut down more frequently, and oftentimes you'll see a local banker who has a relationship with somebody for many, many years in their core business, who says, okay, I'm willing to set up an account for you here. I know you. You're a good person. You've got a good account here, no problems, and so we're going to go ahead and do it. And they don't necessarily get permission from the higher ups, and eventually the higher ups figure it out. They shut them down. Just one common anecdote here that we've heard of. It sounds kind of silly, but it happens. In a relationship like this, where either they just have a banker that's opened the account for them, or where they have sort of hidden what they're doing, we are dealing with a business that is largely cash, and in many of these, particularly the dispensaries, the cash is often kept in the same vault or the same safe that the product is kept, and so somebody will come with a bag of money to their teller. The teller will open it. The money will smell like weed, and they'll tell somebody higher up in the bank, and it gets flagged as a marijuana business, and a week later they get their account shut down.
If I could just add a couple of things. So we're one of, if not the largest operator in terms of the number of jurisdictions we're operating in, and there's a secondary effect that anybody who's interested in this industry needs to take into consideration. If you have a transparent relationship or a non-transparent relationship, particularly if it's not transparent, the banks can turn around and actually shut down the personal accounts and related accounts of individuals. So, for example, if you have a bank manager who is doing their job and delivers cash or whatever the mechanism may be to interact in the appropriate way with a financial institution, if something goes wrong, you're putting your own employees in harm's way. And so from the standpoint of responsibility and accountability, it is such a tricky conversation to have, which, and the cost isn't just borne by the banks. It means that the operators need to have a sophisticated legal team and a sophisticated compliance team that can actually run those traps before it happens, so you don't inadvertently put your people into harm's way.
That's a great point to transition to my next question. You mentioned harm's way. Implied in that is the notion that it doesn't cost zero to change banks. You get fired from your bank, that's a cost for you to hustle, go out and find a new one, change over all those accounts and new checks and the whole 9 yards. Given how many cannabis businesses have been fired by their banks, have we seen any lawsuits filed to ask the bank, particularly those that have actively marketed towards the space and then pull back and fire their clients? Have there been any lawsuits saying, well, banker, now, all right, you have the right to fire us, but you cost us money, you marketed to us, it costs us money to change banks, do you want to pony up?
So the answer is I don't know the answer to that question, but if being in the position I'm in, I can almost have absolute certainty that if I go into a bank and try to establish a new relationship, having been publicly suing prior banks, the likelihood of being able to open that account is literally zero. So I think there's a self-regulating factor in there that precludes people from actually participating in a more aggressive way.
Let me add on to that. As far as the closing of an account, as a banker, I've closed a lot of accounts. And sometimes they're on the recommendation, I'm going to put that in quotations, a recommendation of our regulator, where they just don't like us to be in a certain business, even though it may be legally operated and legally running. But the deposit agreements for nearly every financial institution will have the covenant in there that they can close your account at basically at their discretion without cost.
Yeah, and to add on to what Nick had said, if you think you're going to have a hard time finding a bank account because your account's been shut down elsewhere, imagine if you have sued a bank. As an operator, probably not the smartest move to sue a bank. And you're right. They have a lot of cover. They'll have the covenants in their agreement, but also you may sue based on the fact that, hey, they advertised this and we've abided by the FinCEN guidance, but the FinCEN guidance is not law. And so the bank could make the case in court that, hey, we reevaluate our policies, this is illegal under federal law, and we don't want to bank with illegal businesses. And they would almost certainly win those suits. So I think it would be pretty frivolous.
Can I ask a question?
Sure.
Is there or is there not a list that exists in the banking industry, this is really directed towards you, that a group or an individual can be placed on that literally is like the blacklist, where you cannot open another account? Because I've heard about this, and I don't know if it's real, but that would be another risk factor I'd want to mention.
Okay, there are blacklists out there, and it depends on what segment of financial services you're talking about. So let's just take, for example, MasterCard Visa. Right? MasterCard Visa has a terminated merchant file. And if you break a covenant in your MasterCard Visa agreement, or you break a MasterCard Visa regulation, that institution, your acquiring bank, can place you on that terminated merchant file. Right? And so that's shared between MasterCard and Visa. And once you're on that list, it makes it extremely difficult to ever get another credit card processing account. Right? From a checking account standpoint, there are services like check systems, and if you get placed on check systems, then you can have trouble opening up an account. Now, normally we would put people on those types of lists within the banking institution. Outside of that, from like a federal regulator standpoint, this type thing, there's another highly secret list. It's called the 314A list. The 314A can also include individuals that are just suspect. Maybe it's a suspect drug lord or a suspect money launderer. And those individuals can get hit on that list. And once they get there, the bank's going to search them out and they're going to close those accounts.
So is it fair to say that retailers have more exposure because of their desire to take credit card payments?
I think so, and it's not just the credit card payments, but it's also basic things like payroll. Every service that you take for granted in any other industry that doesn't exist creates another layer of liability. Because how do you pay for taxes? How are you sure that you're accruing for taxes properly if you don't have all of these services that typically people have? It just means more and more headcount to offset the lack of scale and access to those services. So I'd say absolutely.
All right, so let's talk about credit cards then. All right, so if we were having this discussion 1 year ago, Visa was actually okay with processing transactions interchange that were cannabis related. I live just south of San Francisco. I spent a lot of time at Visa. I was actually helping our financial institution partners become members of Visa to establish acquiring relationships so that they could process the transactions. Then back in about October of last year, I got a call from Visa. They said no more. I said, we got a letter from upstairs. We're not going to support this industry for the time being. They didn't give a date. They didn't say we're going to open it up next year, next week, next month. They didn't say, oh, well, after you get more than half of the states rec, then we'll make that change. Right, so they didn't give a date, but basically anything that has a MasterCard Visa logo, it doesn't matter if it's debit, it doesn't matter if it's credit. If it's used specifically for the purchase of cannabis, it is a prohibited transaction at those networks.
Have you seen the writing to that effect, or that was just a phone call?
That was a phone call. Actually, the writing, their public statement was just a statement that you can find on the internet back about 2 years ago. And 2 years ago, they said, we're going to allow our members to make the decision whether they want to be in the space. It was a yes or no type thing back there.
But there's no receipt in writing?
No, there's not.
I just wanted to ask, earlier you said that it's not a very profitable business for banks because it's essentially just a payment facility of an account. But I was wondering, is there anything to preclude the bank, if they do accept your business and host your account, offering working capital, overdrafts and other things? Is that not allowed, or is it not done? Or?
You want to talk practical? Okay. All right. Let me come at it from I'm going to give you a regulatory answer. Okay. All right. You have two problems when you're extending credit to the cannabis business. All right. One problem is the perfection of that collateral. All right. So how can I perfect the collateral I'm making this loan on when that collateral could be seized? So hey, the DEA still comes in, they take product. I mean, the product still gets taken away, and so the bank may not have any collateral at all that they can hang their hat on. And then the second issue becomes, if a bank starts lending to the industry are they going to be viewed that they are facilitating the growth of a federally illegal business? Right, so you have those two things that come into play. From a collateral standpoint, I've just had discussions with bankers and say, well, what if we got a third party pledge the collateral that's unrelated to the cannabis business? And I mean, there might be something there, but maybe not.
Just to add to that, there's also the practical issue of the financial institutions doing diligence on the potential investments. These are all, for the most part, these are all startup businesses. Some may be looking for some growth stage funding, but even then, they haven't been around that long, and there's no comparable businesses that they can look at. So it's not like, I want to open a donut shop, and they can take a look at my plan for opening a donut shop and compare that to the 1,000 other donut shop business plans that they've seen, and the 1,000 other donut stores and how they've done and how they perform. But it just doesn't really exist. And so from a practical standpoint, the ability to do the level of diligence that a financial institution would need to feel comfortable making that investment is not only is it challenging, it's non-existent.
Yeah, right. And a lot of the companies that have investment money, it's not too difficult to find a place to put investment money. But once you start deriving your income, once you derive $1 from the cannabis space, then that's a whole different game.
Have you seen any alternative lending vehicles to get around this, such as banks getting into equipment leases? The cultivation space is, capital intensive. There's a lot of equipment that's needed. And have you seen any equipment leasing sort of sideways banking?
Or real estate mortgages?
So the answer is yes. There are several ways to provide equipment leasing opportunities. In fact, several large companies in the healthcare space that provide equipment leasing alternatives for qualified parties. How they determine who's qualified and who's not, I actually can't answer that question. Just in terms of the mortgage issue, I was looking at my notes from a meeting with one of our banks several weeks ago. There's something called the innocent lender.
And the system is clear at this point in time. Please disregard all previous alarms. Sorry for any inconvenience and delay. Thank you for that.
So the answer is, if you find a bank that can get around the innocent lender risk consideration, what we're seeing is that there are certain financial institutions that are looking at loan to values in the 65% range for properties. And those properties have to be ring fenced. Yeah, it's for hard assets that they can actually get their arms around, and typically they're regional banks or local banks that understand the local real estate market very well. So that is unfreezing, particularly in an environment where you have such low interest rates. Banks they can charge a premium for this type of product because of the industry. And effectively what they do is they triple collateralize their assets. So that is starting to unfreeze, but it's, I'd love to hear your guys' thoughts as well.
Yeah, I mean, that was basically the point I was going to make. That's the primary vehicle we've seen for banks to get involved. It's very much on the real estate side, and especially when either the operator or the really usually it's the real estate owner sort of one step removed from the operator is somebody that these banks have a long-standing relationship with. They've done development deals, so we've seen folks who come out of the real estate development world, in particular, that have these relationships. The banks are very comfortable with them. That wind up sort of the best targets for these types of investments. So that's one of, if not the only ways we've really seen banks sort of get around. It's on the real estate side.
Just piggybacking off of what you tell your clients, Kris, do you offer up any strategies in the banking space? I mean, what do you tell them when they come to you and they go, I'm not sure what I'm going to do? Do you have any suggestions?
We try, but it's challenging, obviously. I mean, the number one suggestion is let's try and identify a bank that's going to do this above board. And thankfully, in all the states that we've been operating in, we've been able to identify at least one bank that is willing to do business in the space. And so we haven't had the issue yet of our clients having to play these games that we see quite regularly in the industry. But we see that a lot. We see that a lot more in California and Colorado, which are a couple states that we're not currently active in. Colorado, banking is still a major issue, and part of that has to do with the volume of stores out there. I mean, there are, and so you still have a lot of stores in California or in Colorado that are still all cash, that have no banking relationships. But so from our perspective, it's number one, let's identify a bank that works. If not, then then we usually refer them to folks who are experts in the banking space. So we can talk more after this, because we're always looking for good subcontractors or side contractors that we can refer them to help them navigate that.
Well, according to the FDIC, there are in excess of 25 financial institutions in the state of Colorado that are banking the space. Right now, they may have one account, they may be just testing the waters, 2 or 3 accounts. There are probably about 4 major players, in the state, that are in the space. But you have to look at this. Most of these institutions, as Nicholas stated, they're smaller institutions. They're community banks. And these institutions can't take on an unlimited amount of deposits. They can't take on an infinite number of clients. Right? So,
Are they trying to keep it on the DL?
Okay.
They'll accept them, but they don't advertise. Are they asking their depositors to keep it quiet?
Okay, you have 2 questions there. So let's go with one. All right. When that board of directors is meeting to determine on banking the space, they are setting limits. So they have to look at the risk and they have to mitigate that risk. And so the board's going to sit down and they're going to come out with some calculation. Maybe it's a calculation that utilizes their asset size. Maybe it's a calculation of their total deposits or a calculation of their tier 1 capital. So they're going to come up with some formula that says, all right, we can do X amount of cannabis business. And once they hit that max, they're done. They can't bring on any more accounts. All right, now when you're talking about are they keeping it down low, one of our clients had a vendor, and that vendor put out a press release that announced the name of the bank. They said, oh yeah, we got an agreement with such and such financial institution. All right. The very next day, they had a meeting with the DEA. So DEA is knocking on the bank's door, and this is in Colorado. Right? 2 days later, the U.S. Marshal showed up. So
At the bank or at the client?
this was last year. This was last year. All right. So part of the reason that these banks and credit unions stay quiet is they don't want to put a big red X on their back.
Did the market close them down? What
No,
did
they
the
did
marshal
not.
show up?
Actually, it was more of just, I'm going to say, more of a threat. They really don't have, or they don't have
Saber
jurisdiction type thing. And so it's more of just, I think it's more of just a power play, type thing.
Let them know they're watching them.
Yeah.
Yeah, exactly. Yep.
Well, I have so many clients come to me and ask me, and granted, my clients are probably different than your clients. I've got some large players, but I also have some pretty well-funded startup players, and when they ask me what to do, the one I get real nervous. It's the only time I get nervous about my CPA license is advising on bank issues. So the first thing I say is, I'm not a lawyer. I'm going to talk to a lawyer. I'm a CPA. Then I say, well, I'm here to share with you what other clients of mine are doing. And they do any number of the following. 1, keep more than 1 account open simultaneously. Even if your second account is just $100, you've got it there, it's open, you transfer the money, the transition's seamless. Number 2, I say, I have to tell you that you cannot lie to your banker. If you lie to your banker, that's a crime. It's not a civil issue, it's a criminal issue, and some people don't realize that. So you can't lie. And I tend to advise clients to stay away from the bigger banks. That, like, parroting off what you said, you're going to get a lot more traction at a local credit union with local folks who know you locally, and they tend to be the soldiers really kind of handling the lion's share of the accounts that I'm familiar with.
They want deposits and they want the revenue. So it's those smaller institutions that are challenged on the revenue side. If you're Bank of America or Wells Fargo, you make too much money with your traditional business to want to deal with the headaches of these cash-intensive businesses.